We manage risk in a couple of different ways. I would say three ways. The first is that we, through the fundamental component of the portfolio construction, we are focused on companies that exhibit less volatility to begin with. So that tends to have us avoid highly volatile sectors of the economy, such as energy and even technology. Now, everybody knows that energy is a yo-yo. Technology is a lot less of a yo-yo because it's done nothing but go straight up. However, upside volatility is still volatility, and we view it as risk. So we manage it on the fundamental side. We also manage risk on the ESG side of the portfolio construction, because we are looking at companies that, relative to industry group peers, are doing a better job of mitigating what we think are key performance risks for their particular industry group. So, some of these risks can be governance related. Some can have to do with relations a company might have with society in general or their own community. Facebook is a perfect example of that. Volkswagen is a pretty good example of governance risk. Wells Fargo, I think, is another good example of a failure to govern. Now, some of these things are hard to mitigate out in a portfolio, because fraud, in the example of Wells Fargo, it's very hard to build filters to detect fraud. But in the case of Volkswagen, which by the way isn't in our portfolio because it's an S&P 500 portfolio, Volkswagen's a European stock, but the point is Volkswagen never would have been in the portfolio because they were something of a laggard from a governance standpoint. So those are the two key ways we manage risk. And then, of course, the third is when there is some sort of an event, which could be an ethical event or likely is an ethical event, we're going to manage risk by actually removing the name from the portfolio. And once we do, we don't tend to look back and question, or we don't ever look back and say, boy, I wish we had held on to that, because that's not the way the portfolio is run. It is really, it is run quantitatively with a rigor around the construction methodology that we've developed and adhered to over 4.5 years. And in some cases, it served us well. In other cases, we've held positions that have gone down considerably, and we don't sell them or change the rules as a part of the portfolio construction. We don't even think about doing that. With a portfolio of roughly 40 names, typical position size initially is 3.5%. So, and it's quite common in running our portfolio that in any given quarter, we might have a stock that's up 15%, we might have one that's down 12%. And so I think really kind of to summarize, the ways we manage risk are on the fundamental side, which many portfolio managers, or virtually all portfolio managers, are doing that. The second thing we do is we manage it on the ESG side, which not a lot of portfolio managers are skilled at. The third thing that we do is we really manage it through position exposure. And I suppose the fourth is if something represents a significant ethical risk, we're going to remove it from the portfolio.